Hell is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, it's Morgan Stanley's urgent warning to all of its customers as a huge wave of selling is about to hit the equity markets at a time when investors are all in. And with the Fed meeting next week, are they about to initiate a bailout for investors? Well, they'll show you why the Fed's next move is more likely to be politically motivated than anything else. And the UK has finally seen signs that it's coming out of recession, but is it too little too late? We'll make the case of why the entire Eurozone is about to head into further contraction. Plus, we have a sponsor for today's show. Telomere Pharmaceuticals is back. You can find them on the NASDAQ under symbol TELO, and they just had a big announcement based on their preclinical trial data. You're not going to want to miss out on this because it's putting a big flurry of activity in their stock, which we think could head another 18% higher. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's go to Bloomberg, where we picked today's story up with a headline. Morgan Stanley's Wilson sees no reason to raise the S&P 500 target. Now, at first look, everybody is bullish on the market. Everyone is crammed into equities. We see the machine positioning is extreme to the long side. We've seen hedge funds, momentum funds, mutual funds, retail investors. Everybody's piling into U.S. equities, and the base call is by the end of the year, it's going to be significantly higher. But Wilson's saying, well, that's probably not going to happen. As the strategist stuck to his year-end S&P 500 index forecast of 4,500, even as a growing list of his peers at firms including Bank of America, Goldman Sachs, and UBS have raised their projections for the benchmark. But what could change all of this is a flood of selling. It's about to hit the markets. Let's continue to look at what Wilson has to say first, and we're going to look at the catalyst of why Morgan Stanley believes that a big wave of selling is going to drive the equity markets lower, as earnings for the S&P 500 grew 7.4% in the fourth quarter from the same time last year. And excluding the Magnificent Seven group of tech giants, profits in the index posted a 1.7% contraction. Wilson added that the risk of a hard landing has still not been exterminated. Now, next week, we're going to hear from the Fed, who's going to brag about how they engineered the soft landing. But Wilson is right. The notion that the hard landing has been exterminated, that's not likely at all. In fact, based on the data we see on this show, we've talked about for weeks and months now, suggests a hard landing is going to be the base case as wave of selling is about to impact the equity markets in a big way. And in Wilson's view, speculative activity across the market has picked up in a meaningful way, pointing to the rise of popularity in zero-day option trading and the use of leverage, noting that exuberance is high. Now, it doesn't have to end in tears, he said. Leverage isn't always bad. We have a situation where people are reaching for risk because there's fear of missing out. And with that fear is about to trigger a massive wave of forced selling. As we look at this headline, it's $265 billion in capital gains tax selling is coming between now and April 15th. As Morgan Stanley warns momentum mulling's coming, well, that is courtesy of the IRS. And of course, that would send all of these leveraged trades moving to the downside in rapid fashion, which could set up a catalyst for a deep drop in equities. A bid from retail is arguably part of the equity market rally this year, but as tax day approaches, U.S. retail investors will owe a whopping $265 billion to the government in capital gains taxes, below the 2022 peak, but still the third highest on record. And yes, these payments historically have an impact on equity flows, which could be a 1% to 2% drag on the S&P 500. That is, unless you start to see momentum funds and machines such as the CTAs start shifting to the downside, covering those long positions and selling down, that could drive the market down even further. But arguably the impact could be more pronounced at the single name level, as estimates that into tax day retail often sells what they have bought over the prior year. And this is a big problem because you see high concentration, crowding, and elevated hedge fund gross leverage in this market, suggesting that any catalyst that starts driving the equity market down could lead to a flurry of selling. Now the question becomes is, what have people been buying over the last year? Well, look no further than the top 10 holdings of the NASDAQ NASDAQ and the S&P 500, and you're going to find names like Microsoft, Apple, Nvidia, Tesla, and Google, and not to mention Meta on top of that list as investors look to unload those positions to pay their taxes. And based on Morgan's data, we have a lot of evidence. We see that retail investors do indeed sell and accelerate those sales into tax season, as you can see on this chart. And then after that, well, they tend not to be very big buyers. In fact, last time we saw them sell. In fact, looking back at 2022, retail investors did owe what was the highest capital gains in history given the strong market rally. That year saw an estimated retail demand fall sharply. And in the fact that it was the start of an 18-month-long retail selling wave, if you can imagine that, of single-name stocks as ETFs continue to get bought. Now, while taxes this year are unlikely to set new records, this year's payments will be a little more average as a percent of the overall market. So keep this in mind. As we head into April 15, we're going to see a lot of selling as people are forced to pay their taxes on this, and that historically has led to kind of a ho-hum market. Of course, you put a lot of momentum in machine positioning started to move to the downside as they cover those extreme positions. Well, watch out. The market could go down a lot. And what type of names are most exposed this year? Well, Morgan says long momentum, long beta, and short value stocks are generally the greatest overlap with the top 50 retail most spot stocks over the last year. This is, again, dangerous positioning. And on top of those risks have been building for a while, hedge fund gross leverage has been moving higher in recent weeks and now stands at 200% per the Morgan Stanley PB Content team, the 99th percentile since 2010, suggesting a lot of people are going to be caught on the wrong side of this market. But will a big market sell-off cause the Fed to turn and bail out investors? Well, next week we're going to hear from Chair Jerome Powell and his cohorts on their move on monetary policies. Not that we're expecting much, but one thing the market is looking forward to is some sort of comment on their balance sheet. What we think, this is more politically motivated of what's coming than anything else. As Wall Street sees risks of later start date for Fed's QT tapering, as many people are hoping the Fed is going to back off on their balance sheet unwind and do it soon. And while a handful expect the Fed to announce or even begin slowing the unwind of its balance sheet, a process known as quantitative tightening, as early as May, others don't see it tapering starting until the second half of this year. The divergence comes from a myriad of variables that could affect the timing of slowing QT, from the drainage of reverse purchase agreements to the emergence of funding strains brought on by a scarcity of bank reserves. Now, what's notable here is neither of those things are issues. What's going on in the reverse repo market has nothing to do with QT, but everyone thinks it does. And bank reserves, that's nothing more than cash in the bank accounts. And that's not an issue either, because why do we have a shortage of bank reserves? Because banks aren't paying a competitive rate of interest. Again, nothing to do with quantitative tightening, but don't let even the experts fool you. As policymakers like Dallas Fed President Lori Logan have said, a central bank will likely be able to slow the pace at which it shrinks its balance sheet as a reverse repo facility empties. And slowing the pace doesn't mean the central bank will stop QT altogether. Notably, the timing of this would be ahead of the election and would be seen by many as politically motivated to help the incumbent president get re-election. And that is a big concern because central bankers in 2019 learned a lesson when different overnight market rates soared fivefold to as high as 10%, and the central bank was forced to intervene. But the notion that there's any relationship between this overnight reverse repurchase agreement shown in red and the Fed's balance sheet in blue. Now, if you're wondering what overnight reverse repo is, well, it's where you go to get treasury securities if you have too much cash. And who has too much cash right now? Well, that's money market funds. And what do they want? T-bills, overnight securities. That's what it does. Is the Fed rolling off T-bills off their balance sheet? Not at all. And that's where people have this wrong. But the real reason we're likely to see the Fed trim down from their $60 billion a month sell-off, maybe to something around $30 billion, is they're running out of maturing securities to do this. That was a tenet of the QT program, was that we're going to roll off maturing securities only. We're not going to do any hard selling. Well, the problem is we knew many years ago that this day was eventually coming. It just may be coincidental. Perhaps you think it's politically motivated. Love to hear what you think. Weigh in the comments. But now let's talk about the UK economy. Is it looking to get out of a recession as we see the data rebounding in January after slipping into a recession? Of course, no one really said it then, but now we're talking about it. As gross domestic product rose 0.2%, following a 0.1% decline in December. Services and construction delivered the gains, offsetting a drop in industrial production. And that's one of the big dangers here, because when you see industrial production drop, well, we know looking back, it has a big impact on the labor market, because when industrial production goes down, that means these companies do not need as much labor. They tend to lay people off, and those people in those jobs that lose them tend to stay on unemployment longer. That means their discretionary spending goes down. You start to create a bit of a feedback loop. At first, it looks very benign, and then it accelerates. However, the recovery is likely to be modest, well, at best, we'll say, as past interest rate increases continue to feed through to households and companies, as banks continue to constrict credit and central bankers continue to keep those yield curve and money curves inverted. Analysts expect the UK to trail every other group of 7 countries except Germany, well, who we're noting is headed into a depression for another year. And yes, what matters here is what these central bankers are doing by constricting the creation of credit. And they simply do that by inverting the yield curves, driving short-term rates higher than long-term rates. In that case, because banks borrow at the short term and lend at the long term, that means they lose money lending. That means financial conditions tighten, banks raise other fees, and that means less money is injected into a debt-based economy, and eventually it drives a major slowdown. Here we can see the net percentage of domestic banks, this is for the U.S., of commercial industrial loans to firms of all sizes. That's shown in blue, showing how they're tightening standards anytime that blue line is over that horizontal black line. And we're overlaying the U.S. real gross domestic product. And what we can see, as banks tighten standards, at first it doesn't really have a major impact on the economy. And then as a lag hits, next thing you know, you see economic production data head lower. You see that happen again during the global financial crisis. Now everybody believes this GDP rate is the new normal. We'll make the case of why in the quarters to come that's going to roll over very hard for the downside, including for the UK, because central bankers have not let their foot off the brakes at all. And based on what we're going to hear from the Fed next week, no chance anytime soon. And as far as the UK goes, the labor market is cooling off slightly, and you look for these headlines to say accelerating in the future as the Bank of England weighs on rate cuts, and UK wage growth eased marginally as the unemployment rate ticked up. A small relief to Bank of England policymakers, hoping that labor pressures would ease ahead of expected interest rates cut this year. So it's important to understand, it's not just the Bank of England, it's the Federal Reserve and ECB and every other major central bank in this world. They all want you to see fewer and smaller pay increases. That is very important to them because they don't want people to keep up with inflation. That is key, because if your wages don't keep up with inflation, it means your spending goes down and inflation comes down. So I want you to understand why they're positioning this way. The headline measure for average annual pay growth, excluding bonuses, was 6.1% in the 3 months to January, compared with 6.2% the final quarter of 2023. Historically, this rate is rather high, so notably, it was the lowest since October 2022 as we look around the world and we see a continued deceleration in average annual pay growth. Meanwhile, as I've noted, when companies start cutting back on pay increases and they've reduced the frequency of them, now that means people are hitting the unemployment line, and sure enough, the rate of joblessness grew to 3.9% between November and January, a little higher than the 3.8% in the 3 months to December, suggesting, as we've made this case on the show, that slowing pace of wage growth, while maybe wonderful news if you're a central banker, is not good for the global labor market. It's going to lead to further increases in layoffs. Now, we started talking earlier about the downturn of industrial production and why this is so dangerous. Yet what we hear is, of course, the UK may be coming out of recession, not for long, as we look back now to the entire Eurozone, as we see production there slumps as the economy starts 2024 with a stumble. Output in the region fell by 3.2% in January from the previous month, whose increase was also revised down markedly. Eurostat said on Wednesday the decline from December was notably worse than the 1.8% median forecast of economists surveyed by Bloomberg. So everyone believed that the Eurozone was going to see a downturn in industrial production. That's going to lead to higher unemployment, but they still have optimism here that their economies are going to come out of these recessions. Well, heading back to the U.S. data, highly unlikely as well, because we'll look at the link to industrial production and real gross domestic product. And what we can see is industrial production in blue, both on a year-over-year rate of change, leads real gross domestic product to the downside in every instant. Now, right now, we see a resurgence in U.S. real GDP, and a lot of that was on the back of a massive amount of financing, credit card spend, those buy now, pay later loans during the holidays, put a real big surge under the U.S. economy. That unlikely to last unless we see industrial production turn markedly higher. And based on what we're seeing around the world, that is highly unlikely. And so when you start to put all of this together, a wave of selling as people look to exit their high positions that they've made money on, perhaps rotating into other stocks. One of those we think people are going to be taking a look at is our sponsor for today's show, Telomere Pharmaceuticals. You can find them on the NASDAQ and the symbol TELO. Let's take a look at what this company's been up to, because they've got some really amazing data this coming from their preclinicals. Let's take a look in all the information on telomere in the pinned comment and description below. And telomeres are the end part of the chromosomes that serve to protect the DNA, just like shoelace tips prevent a shoelace from unraveling. And when telomeres shorten to a critical length, the cells stop dividing and either become senescent or undergo apoptosis. And telomere shortening has been discovered to be the primary cause of human aging. Short telomeres have been associated with almost all age-related chronic diseases. Now, let me show you something that this is a really cool case study, and this was coming back on December 25th, 2022, reversing aging through reprogramming of stem cells. And yes, they did this on mice, and what you're about to see is these mice have an equivalent, or 350 years old, based on, this is again, based on human equivalent. This is fantastic. This is amazing. And here you can see on October 4, 2022, this mouse was dosed with a non-toxic oral metal enzyme inhibitor of 10 milligrams per day. And what happened, the animal started out was frail, inactive, thin fur, dull eyes, ears back and bent, feet appear weak. And day 7, wow, you can see a big change. Day 14, how about this? Fur is thickening, ears are up, activities increasing. And well, by December 25th, 10 days of the re-challenge, the mouse had completely transformed to a young mouse. For the second time in 90 days, at complete transformation, the fur is thick and shiny, complete age reversal with manifestation of young stem cells. But check this out. Telomere Pharmaceuticals presents promising preclinical data for its lead development product at a Singapore conference. We can see here that alongside its partner, Frontage Laboratories, they presented a scientific poster at the National University Health System of Singapore Center for Healthy Longevity Conference of 2024, with data showing the effect of telomere 1 on telomere length in 3 human cell lines. The data presented was garnered from preclinical studies that Telomere previously disclosed it was undertaking. This is a huge deal, because what it's showing is they're targeting age-related inflammatory conditions. You can better believe there is a monster of a market for that. And based on this news, we've seen actually their stock decline a bit, and now all of a sudden a flurry of activity driving it higher, heading back into its volume profile line. Based on where it's trading as of today's show, we see another potential 18% move in the stock. Here you can see sellers getting worked out as they drove stock prices down, buyers stepping in a big way, squeezing now as these sellers are getting worked out, suggesting that the stock could drive up 8 18% back up to its volume profile, where it's been sitting around $9.02 for most of its trading history, would create an impressive opportunity, as what I think is once this word gets out about what Telomere Pharmaceutical is doing, they're going to see a lot of investment from some very deep-pocketed wealthy people who want to extend their life as well. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.